Please pay close attention. The next 30 seconds can make up for all your stock market losses this year and even save your retirement. You'll have a rare chance to hear from two Wall Street legends, Mark Chaikin and Joel Littman. What Mark and Joel are going to share with you may make or break your retirement. A way to 5x your money, even if this market crashes another 20% this year. And they say what's coming before the end of the year will create and destroy fortunes, depending on which side you're on. Let's face it, the stock market's been a minefield this year, with the biggest sell-off we've seen in 50 years. And thanks to inflation, even cash isn't safe anymore. Your money's losing value even as we speak, at a rate we haven't seen since the 1980s. They'll be giving you a financial lifeline that could erase this year's losses for you and trigger a wave of potential wealth that's so powerful it could save your retirement. For a sneak peek of Mark and Joel's big reveal, go to wealthcrisis2022.com. That's wealthcrisis2022.com. Welcome to Making Money. This is Matt McCall. Thanks for joining me. It is Thursday, September 29th, 2022, and I'm happy to say we made it through the hurricane down here in South Florida. Unfortunately, a lot of damage on the West Coast, and my prayers are with anybody who's been affected in any way, and we hope for the best of what becomes of that. But again, prayers out to everybody who's been affected by the hurricane. Today, we have a great guest, Peter Boockvar. He has been around a long time. You've probably seen him on television. He's a CNBC contributor. He's one of the straight shooters out there in the market. And we have a great conversation coming up. Everything from stocks, his view where he thinks the market's going, to commodities. I get his view on gold. You know my view on gold. We talk about interest rates. We talk about the Fed. I mean, I got to tell you, folks, we really cover the gamut of topics when it comes to investing. And we get Peter to share the one stock that he'd buy for the next 10 years, his favorite company. It's an individual stock that you may not have heard of. You probably heard of it, but it's a stock that's never been recommended on this show before. So we have all that and more coming up right now with Peter Boockvar. Again, welcome to Making Money. This is Matt McCall. As I just mentioned, we have a great guest on today. First time on the show, Peter Boockvar. And he is a chief investment officer over at Bleakley Financial Group. It's an $8 billion wealth management firm. He's also the editor of the Boock Report, but it's spelled B-O-O-C-K. He provides summaries and commentary on macro data and news. And if you've heard him before, back in the day, he was a chief market analyst for the Lindsay Group. And he graduated magna cum laude with a BBA in finance from George Washington University. Peter, thanks for joining us for the first time.
Thanks, Matt. Appreciate having me on.
Yeah, our pleasure, of course. So we talked right before we jumped on here. We have a lot to talk about. There's a lot going on in the market here today. We had a bit of a bounce back rally on Wednesday after 6 consecutive down days on the S&P and the Dow, and then selling off again here today as yields continue to remain a bit high. You just want to kind of give us your big, 20,000 foot look down on the market right now in your view?
I think the central bank tightening in response to high inflation is putting a squeeze pretty much on everything. And the setup going into this, I think, is also a reason for the pronounced reaction. We've been, when I say we're talking about the economy, markets, valuations, have been so medicated on artificially low interest rates for so long, whether it was zero, whether it was negative overseas, with all the QE and everything, that was sort of the world we knew. And this is now the world we really don't know, unless you were trading markets in the 1970s, with respect to both inflation and the central bank response. So now we're reaching a point where accidents are beginning to happen, and the economy is slowing. Now, obviously, the energy crisis in Europe is irrespective of what central banks are doing, but it happening all together at once is, I think, a shock to the system, so to speak, that markets are struggling how to handle, and the economy is trying to figure out how to maneuver through it themselves.
Yeah, and we're also in a really odd situation where we're in a bear market and the Fed's actually raising rates. That hasn't happened in decades. So this is a bit unprecedented when it comes to that. Obviously, I think if we have to have comparisons, we have to look at the 70s. If any time frame, I wasn't trading then. I'm sure you weren't either. So where do you see
I was trading
kind of
baseball
the?
cards.
I was trading football cards, so very very similar. So when we look at the market here, and because we are in a very different situation, we're trying to get off the Fed, with these artificial low interest rates, as you mentioned. At what point do we get to a level in equities that we say, okay, we've priced in this now that it's attractive for long-term investors?
Well, trying to call the bottom in a bear market is as difficult as calling a top in a bull market. It's very difficult. Now, that said, bear markets create a lot of opportunities. I'd rather be buying a lot of stocks in a bear market than having to chase things in a bull market. So I don't think that we should try to figure out what the bottom is, because it's very difficult. Although I think the bottom is below where we are now for a variety of reasons and valuation metrics. You take valuation. We swung the pendulum pretty one directional when we got to 22, 23 times earnings in the S&P, and then the pendulum is now going to swing in the other direction. And if the mean is, call it 15 to 17, give or take, right now we're at about 17, the pendulum doesn't swing and stop in the middle. It usually goes in the other direction. So all you do is take what I believe will inevitably be more of a lower teen type P multiple, and then go try to figure out where S&P earnings are going to be, and that can give you sort of a range of outcomes of what the potential is on the downside. But for the average investor, I wouldn't just sit there and wait, because those levels may never be hit, but have dry powder to, as the market falls, add some money. As the market falls, add some money, because the cheaper you pay for things, the greater your future returns will be.
Yeah, you use that pendulum analogy. I use that all the time, and producers are probably sick of hearing it, but I love that. And because it's driven by emotions and psychology. So you get so hyped up on the top, and then we get so bearish. And we saw the AAII number come out again this morning. Only the first time ever we've had consecutive readings of bears over 60%. In over 1,800 weeks they've been doing this. Only the first time ever we've had consecutive. So it shows that sentiment right now of how bearish people are. But I agree with you. I think we could have another leg lower. We're kind of testing that double bottom right now in the major averages. If we break through that, October is the month of crashes. It's also the month of bottoms. So we can maybe see some wild swings, I think, in the next month. So let's go back to interest rates, though, because I think this is important. I think it's driving the market. What's kind of your view on the Fed? Obviously, we believe probably 75 basis points at the next meeting. Then, people are saying 50, then 25, then they stop in February. Are you kind of along the lines of believing that is the path of the Fed going forward?
Well, initially I thought what would get the Fed to stop. Now, it's clear that the Fed wants to get the Fed funds rate to 4 plus, based on a lot of the comments. And that means either another 100 by the end of the year, 125, as they implied at the last Fed meeting. So that implies 75 maybe in November, another 50 in December, or 50-50, whatever. So the question is where maybe they go above that. And I think a lot of that will depend on, well, I don't think they're going to go above that. I don't know if they're going to be able to get away with even 2 more of these rate hikes if what the Bank of England did is any indication in terms of losing control of the bond market. Because what happened in the UK is likely coming to a theater near you in the US, because there's a lot of similar circumstances. I thought originally the Fed was going to stop when the unemployment rate would get to 4.5 to 5. But now I'm wondering, on the heels of that Bank of England move, whether it'll be more market dislocations that causes the Fed to stop. Either way, I think we're still coming to the tail end of these rate hikes. Of course, with the balance sheet, we're only just beginning the shrinkage of the balance sheet. So while the Fed may stop raising the Fed funds rate after it gets to 4-ish, they plan on continuing to trim that balance sheet. But I don't know how far along they're going to get with that. Again, if what happened in the UK is any indication of how markets are going to respond to fragile liquidity conditions, and that liquidity drainage.
Yeah, I agree with you. I was a bit shocked when I saw what what they did over in the UK, and obviously that sent stocks higher yesterday, but didn't last more than 24 hours. I mean, it didn't really hold much water. Um, if we're talking about interest rates, we have to obviously talk about inflation. Uh, I'm in the camp, just real quick to let you know. I think we are near peak inflation because you see energy prices come down and a couple other of the indicators. I think the key though is going to be shelter, which is about 1/3 of the CPI, as you know. Rents continue to go up. Home prices starting to roll over a little bit. And if rents start to roll over, I think we could see CPI come down, which would be really good for stocks. Do you see CPI being near a peak? And you think that what the Fed's doing will eventually roll into the market and get inflation under control?
So, from the perspective that I got concerned about inflation back in 2020 and got even more worried about inflation after the Pfizer efficacy news on their vaccine in November 2020, um, and calling for inflation all through last year and into this year, I do think it's clear that and let's separate out services and goods here because I think that's important. And the reason why it's important is because there's no such thing as deflation or disinflation when it comes to services inflation. The 20 years leading into COVID, services inflation ex energy within CPI averaged 2.8% a year, every single year per annum on average. The 20 years leading to COVID on the good side, core good side, ex food and energy, was flat, was zero. So that's why we averaged about 1.5 to 2% type of inflation when you marry those together. So on the good side, there is clear declines in prices. In fact, I think it was 5 months in a row, and then the last reading was sort of flattish. We had a moderation in the rate of change in core goods prices. But I do think we'll continue to see a deceleration on the goods side. The services side, of course, as you mentioned, rents, and it's this weird dynamic and I follow the real world rental calculations from a variety of different providers, like Apartmentlist.com's National Rent Report, which just came out 2 days ago. They saw new rents rising high teens in the beginning of the year, and that rate of change is now slowing to below 10%. So the inflation numbers are driving one way, and the Fed is looking at the CPI, which is capturing rents in a delay fashion, going the other way. So there's still, in the CPI calculation, we're still going to see a lot more months of rental increases, even though in the real world, the rate of change is definitely slowing down. Net, inflation is certainly topping out and rolling over. I think the real question is next year, is to what extent does it roll over? And even the following year, 2024, where does it settle out? Do we just go back to the 1.5 to 2% world that we lived in pre-COVID? Or are there structural changes that have taken place that will have that rate more settle out, maybe 3 to 4%, which obviously is much better than where we are today. But that's a different environment, new regime than the markets are accustomed to.
That's a great point because this 2% number everybody talks about. So the Fed talks about that's the goal. But would we be okay as an economy if it settles in at 3? If that's the new normal? I mean, would that be all right? And part of me thinks, yeah, I think we could get away with it. And again, it's much better than what we have now. You did a great job of breaking down services and goods. I think that's very important for the viewers out there to recognize that. Just to give you a quick story, I just bought a TV like 3 days ago, a 75-inch TV. It's so damn thin I could barely even see the thing. It was like $900. And it's just amazing, thinking back as a kid, how much I paid for my first flat screen. It was probably $3,000. Not a kid, but as a young adult.
Well, that's why, the goods inflation really is in the 20 years, again, leading into COVID, it was zero. Now we had that, obviously, the cyclical spurt because of where a lot of people spent their money over the last couple of years. But, technology is a deflationary force, and TVs are, of course, the perfect example of that, as is, a laptop or any type of computer. Yeah. But it's the services side that tends to be more sticky, and we've certainly seen that, and we will continue to.
Do you see services continue to stay high due to the employment situation? Service industry having to pay servers more, cooks more, anything. I own a Pilates studio. The teachers get paid more and more, I feel like, every year. They're making good money. So how does services ever come down if we're in that trend that we're in right now?
So about 2/3 of the average service business, the cost of their expense line is labor. Actually, you can almost say that for most of corporate America, but call it 2/3. So yeah, as wages go, so goes profit margins, depending on how productive you are and what sort of pricing power you have. But if you look at picture the profit pie, and in each and different slices get given to different people, the employee piece of that pie back in 2015, call it, was the lowest since World War II. And since then, slowly but surely, labor has been getting a bigger piece of that pie, and now that is further accelerating. And even if wage growth doesn't accelerate further from here in terms of rate of change, but settles out at this 4 to 6%, that's a clear step up than the wage gains we've seen for the last decade or two. So there's no doubt that labor has more leverage, and to their benefit here, but to the risk of being a headwind to corporate earnings and profit margins.
Yeah, that's a great point. You talked about rents. We talked about shelter. What's your view on housing prices right now? Obviously, it's regional. I'm down here in South Florida now, and prices still remain pretty damn high. Supply is just low, and a lot of people moving from New York every day, like myself. So, do you see it becoming an affordability issue as well? We have interest. I think the 30-year hit 6.7 today, something outrageous. You're taking now a home that 2 years ago, where it was to where it is today, you're almost paying double. I mean, it's crazy how much they've gone up with home prices and interest and mortgage rates combined. What's your view kind of on housing right here?
Right. So you take that near doubling, and then you double the mortgage rate, and you have 75 to 80% increase in monthly payments. So it's clear the squeeze that is going on in terms of buyers. Now, it really mostly affects the first-time buyer, because if you already own a home and you went from wherever to Florida, you sort of played with house money, no pun intended. So if you had to pay up, well, you sold up. It's really that first-time buyer that really gets hurt by the Fed creating another price bubble in housing not so soon after they created the previous one. So that means that more people rent. It will take that wannabe home buyer more time to save up for a down payment and to better manage their monthly payments. And it has dramatically slowed the pace of transactions and will continue to be the case. And all the ripple effects that has. If you take housing all in, and I'm not just talking about buying a house, but remodeling a house and painting it and broker fees and everything, according to the National Association of Home Builders, it's about 15 to 18% of U.S. GDP. So it does have a broad reach in terms of its impact on the U.S. economy.
Do you think we see something similar to 07, 08, where we have basically a housing bubble and people are underwater, that have been buying the last couple of years? Or do you think it will kind of stabilize a little bit prior to that?
Well, we had a price bubble this time around, but the difference is people have a lot more equity in their homes. I think we have a much lower risk of foreclosure. I think a lot of people that are living in their homes are in 3% type mortgages. So this rise in interest rates, if they're going to stay where they are, is not going to really affect them. And also in 06, 07, 03 to 06, when everything was on fire, that was a lot of just pure speculation when people flipping homes, as opposed to buying one and living in them. Now, of course, there was collateral damage. It forced somebody who wanted to live in a home to have to pay up for it, and they got hurt. But a lot of those people were also in adjustable rate mortgages and all these fancy, quirky named loans back then, where now there's been much more sort of conventional loans that people can handle. So I don't see the similarities. And of course, back then you had the banks that were holding a lot of this bad paper, and the banking sector balance sheet today is dramatically better.
Good. I'm glad to hear that because I agree with you on that. But every once in a while, obviously, we know we both have been in media. The negative headlines tend to get the headlines. The bold calls.
Now, that's
One
not
more
to say we
topic.
don't get a sharp decline in prices. I
Sure.
just don't think that we're going to see a repeat of 07, 08.
07. Okay. One more topic before they go. Commodities. What's your view on commodities right here? Obviously oil's come down quite a bit. Gold, I'm not a big gold fan, but you think in the last year or two, with inflation going through the roof, gold would have done much better. Obviously, it's being hurt by a strong dollar. But what is your view overall on commodities now? Is there a place for that in portfolios?
So I've been, just so the viewer has perspective, I've been bullish on commodities since 2020, and more so, and I'll use this again after Pfizer's news. I keep bringing up Pfizer's news because the day that Pfizer said that their vaccine is north of 90% efficacious, that was the game changer. That was the light at the end of the tunnel and the beginning of the end of COVID. And that was the beginning of a broader reopening. So it's around then and just prior that I became positive on commodities. I think right now the sort of tug of war is the supply side with a variety of different things, whether it's fertilizer, whether it's getting corn out of the ground, whether it's getting enough barrels of oil. The supply side is still very much challenged. But the challenge in terms of from the investing side is, well, the demand side, particularly with industrial metals and energy, is now being impacted by the global slowdown / global recession. I think the net result is this: what we're seeing is this pullback. But I do think that the supply issues are so challenged for a variety of different commodities that on major pullbacks, I would be buying commodity stocks. With respect to the precious metals, I've definitely been bullish and wrong. I've been long them for the last couple of years, particularly on the inflation theme, and they certainly have not been an inflation hedge like I hoped they would. But I think a lot of that has to do with the Fed's aggressive response and the sharp rally in the dollar. But even with just central banks around the world now getting more aggressive, the rate of inflation is still well above interest rates. And if you believe that central banks can sort of pull this off and everything's going to be fine with their tightening, we'll have a soft landing, and central banks are the king, then don't own gold and silver. If you don't have that sort of faith, if you think that they're going to screw this up and that inflation is still going to remain elevated relative to interest rates, and if you think that fiat currencies generally are going to be under stress, including the dollar, then I would be owning gold and silver, and I'm in that latter camp.
Yeah, I think I'm mixed there. It's tough because I don't have faith in in the central banks. I'd like to hope that we gives us a soft landing, but I have to be honest with you, I don't have it. One question I ask every guest, they don't have to answer it, but I call it the island question. If I sent you and your family and your loved ones to the most beautiful island in the world for 10 years, but you couldn't have any connection to the outside world, what is the one investment you would buy today before I sent you out there for the next 10 years?
I mean, stock-wise, and full disclosure, we own it for clients and I own it for myself because I believe that in 10 years, the world will still have pets. I would say Petco is probably a safe one, assuming that they execute, and there are no surprises from that end. But I know the demand side for spending on pets will only be much greater in 10 years than it is today.
That's a unique answer. And I love that answer because I just moved into a new place, a little temporary place down here in Delray Beach, and everybody's a pet. I am the outlier by far. I mean, and multiple pets. You can't get in the elevator without having a dog, kind of sniffing at you. And I've never been a pet guy myself, but it's amazing how everybody has a dog down here. It's absolutely fantastic. It blows my mind. So I love that play. I mean, that's a trend, like you said. People aren't going to stop owning pets in the next 10 years unless we start getting little robots, right? Robot pets. That's the only thing I can see that could mess that up. But that's great. That's a great answer. Yeah. Well, Peter, hey man, it was great having you on. Thank you so much for coming on for the first time. We'd love to have you on again in the future. And you shared some really great information for our viewers. And I really appreciate what you do.
Thanks, Matt. I appreciate having me on.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.